Let's put the focus on Indian hotels now. It reported its best fourth quarter performance ever. Margins have expanded and operating leverage. New businesses have also reported growth of about 35% or so. What's the outlook looking like for FY25? That's the question, isn't it? We have Puneet Chhatwal, Managing Director and CEO at Indian Hotels, joining us now. Puneet, good morning. Great to have you with us here on the program. Prashant this side. Travel and leisure and hospitality continues to boom. And I think that's what the FY24 numbers show us. Revenues for the full year have grown for you 17%. EBITDA is up 20%, margins of 32%, and net income up about 25% or so. Give us, to start off this conversation, let's get the numbers out of the way, and then we'll talk about, the finer aspects of the business, the nuance, etc. What's the guidance for FY25? Will you maintain this kind of run rate?
Morning, Prashant. What we have given as guidance is opening 25 properties at a minimum in this coming 12 months. And we had guided 20, we opened 20 last year. If we add the Tree of Life to it, then it goes to 34. So I think on a growth trajectory, we have been delivering on that promise, and the capital light growth is helping us drive the margins. And the capital heavy with good, smart renovations is helping us drive the operating leverage. And our guidance remains the same. Why change a winning combination? All we have done is we have increased the CapEx spend because we are going to spend a lot of money on digital initiatives, on our new ERP, on our new data lakes, on our new websites, which we start launching the very first one in the next 10 days, and then for all our brands. So I think with smart renovations, effective asset management, digital initiatives, growth on all fronts in terms of number of hotels, number of homestays. We signed last year 105 new AMA branded homestays. We are now more than 100 in operations. And also cumin, bringing cumin to every ginger property has proven to be a good formula for us. So all in all, we are very pleased with the performance, and we do believe that we're going to sustain it for many, many years to come.
So, again, got that, and that's well put, Puneet. Margins of 32% are maintainable in FY25?
Yes, for sure. We are not into cost cutting, as I just now said. We are actually spending. We are supporting our new businesses. And as you mentioned at the beginning, we are looking at 30% plus CAGR on our new businesses, which requires more advertising, which requires more websites, which requires more people. So we have been doing that for the last 6 to 9 months under the vertical of new business, and we are very, very, optimistic that this journey will continue because demand will continue to outpace supply. And for our portfolio, there are 2-3 important elements which have not yet kicked in. First, the foreign tourist arrivals is at an all-time low compared to the pre-COVID. Of course, last year we had the benefit of G20 in terms of statistics, but it still did not achieve the number of pre-COVID. So I think there is some movement expected to happen there, which will help our palaces and our iconic asset portfolio. Number 2 is the US has been lagging behind also on the pre-COVID. And we have taken some steps which will help us going forward. And finally, I think the journey that we commenced on our not like-for-like growth with more than 90 hotels in pipeline, we expect to open more than 100 hotels over the next 3 to 4 years. This will really help because of the balance that we have created in capital-heavy and capital-light businesses.
Puneet, hi. Always great speaking to you and understanding how the hotel industry is shaping up. But I have a couple of questions, right? How long do you think this runway of growth is going to last? And at what stage of the upcycle are we in the hotel industry? Has it reached a mature stage already?
Sonia, can I answer a bit on a lighter note?
Always.
2 years ago, and I said the rates will go up. You asked me last year, I said, no, the best of the rates is yet to come. And my answer does not change. With the kind of service we are providing, and post-COVID, the divide in the West and the East has, grown significantly, that your ability to charge and people's willingness to pay has increased, and also the appreciation of dollar. Pre-COVID, we were at 65, 66 rupees. Now it is at almost 83 point whatever. If you convert that back for our most iconic part of our brandscape, that is the Taj, we are still like close to only $200 average rate. So I think this journey will continue. And as India grows from fifth largest economy to fourth, and then finally to third, the per capita income will also grow. And if the per capita income grows, the discretionary spend becomes a normal consumer spend. And that has been my belief, and that's what we've communicated.
So you also made a point, Puneet, that foreign tourism is still relatively low and it's expected to pick up going forward. The other three pockets I wanted to ask you about, one is spiritual tourism. You also have the resurgence that you're seeing of medical tourism, right? I mean, that as well is picking up in a big way. And then you have luxury or premium tourism. Where do you see the maximum potential now over the next 12 to 18 months?
See, spiritual tourism is very important and has always been. Actually, we started talking a lot about it, maybe in connection with Ayodhya. But, we have been in Banaras and we are expanding our hotel, doubling the size of the Taj Ganges because the demand level is so high. And, many other we have added a second hotel in Tirupati. We have 2 hotels in Katra. So we are in 50 plus spiritual destinations with 60 plus hotels there. The beauty of spiritual tourism is on the room demand side, it helps you in resilience. So for good or for sad or for happy reasons, people do go for, spiritual weekends or weeks, if I may say so. The second important resilient factor that is a part and parcel of the Indian subcontinent culture is the weddings. This is a very big business in India, and we are very well positioned to take advantage of the wedding segment, and that keeps growing. But more importantly, I think a lot of people tend to forget that the facilities that have been built, like the Bharat Mandapam, the Yashobhumi, both in Delhi, the Geo in Mumbai, the Kolkata Convention Center, and many others that are coming all across India, the new 4-lane highways, the airports that are being added, doubling of the number of airports, the number of new aircrafts coming into India. This is going to lead to a very different kind of a positioning of the sector in the next 2, 3 to 5 years. And I just think at the moment, we have not even captured 5% to 10% of the possible demand because these centers are either in an opening phase or just open because of G20. But as we all, Sonia, are in Mumbai, if an event, a big event is happening at Geo, within the 5-kilometer radius, there are no rooms available. So these kind of structural changes and shifts are going to really boost the hospitality sector. And we being the largest ecosystem in this sector should get our fair share of that benefit.
All right. Hi, Puneet. You're sounding very, very confident. Now, Vision 2025 was achieved a year ahead. So what's the vision for the next 5 years? If you could run us through that and also fill us in with what's the difference between margins between domestic as well as international business and what's the upside there?
Nigel, I think on the guidance, we will very soon announce our capital market day and give it at the same time to all. But mainly the growth journey will continue. I think if 5 years ago we had said we'll be a portfolio of 300 plus hotels, and at that time we were 120, very few believed us. When we said aspiration 2025, that we'll do 25% margin, very few believed us. Now we have the other side when we say 33, people say, why can't you do 36? So I think management's job is to navigate through all these situations. And I think 30 plus percentage margin on a healthy top line is good. And I would also like to state here today that in our last announced results, our standalone revenue is higher than what was pre-COVID for the consolidated portfolio. And it's not coming just from like-for-like portfolio, it's also coming from not like-for-like portfolio. So the guidance remains effective asset management, use capital heavy as an opportunity to drive higher returns, because we have such beautiful iconic assets which are sitting over so much of space, including FSI that we can use intelligently, and we've been doing that. Drive margin expansion through capital light businesses as well as new businesses and scale them up so that the volatility in the portfolio declines to the best possible or the optimal possible level.
Puneet, one of the triggers that you mentioned, which could play out, is foreign tourist arrivals, right? Especially US arrivals from US, etc. What will cause that to happen? I mean, why is that still low, according to you, briefly?
There is a shift, just like there was a shift of, customer behavior during COVID and post-COVID and people driving with families on a holiday. There has been a temporary shift because of the pandemic. People have stayed more at home, and it was also complicated getting visas, etc. It took a longer time. And then we all know that in certain countries, we had also put embargo for people to come in. So I think all in all, everything also goes back to some form of a new normal. And I think in the new normal, the foreign tourist arrivals in India will grow exponentially in the years to come. And why should it not grow? We have 7,500 kilometers of sea mass. We have 500 plus beaches in India. We have the mountains, we have the temples, we have all possible religions represented in India. We have the Buddhist circuit. So as India grows, as India develops, all these new circuits are already developing and will develop. The life will not be just limited to Golden Triangle, Delhi, Agra, Jaipur, and extended to Udaipur. So it could be, Delhi, Banaras, Ayodhya, Sarnath, the Buddhist circuit, the Northeast, which is coming up very strongly in terms of business. So I think a lot of new things are happening in India, which should boost both domestic tourism as well as international, but more importantly, business. India is becoming a preferred business partner for a lot of important and large economies of the world. And I think that will bring in new business into metros, and the supply will remain constrained, which will give us as a sector the ability to charge and also have good occupancies.
Absolutely. Well put and well-rounded there, Puneet. Thank you very much for joining us. It's a pleasure having you with us here on CNBC TV18, and good luck to you, to your team, which has been executing fantastically well over the last many years now. Thank you.